Hello everyone, and welcome to this video in the Learn Technical Analysis series brought to you by thetechnicals.com. Today we're talking about price-oscillator divergences, which is just a term for changes in price momentum based upon differences between price and an oscillator. But before we get to that, as always, just a quick risk disclaimer. Trading in the financial markets carries a high level of risk and may not be suitable for all investors. Before deciding to trade in the financial markets, you should carefully consider your investment objectives, level of experience, and risk appetite. Okay, let's get started. So what exactly are divergences? Well, divergences are simply imbalances or disagreements where extremes, the peaks and troughs, in price and an oscillator diverge in relative direction. Now, divergences are used primarily as warning or confirmations of significant potential price events, whether these events are a turn or a reversal in price. Divergences support trading decisions that are derived from other technical and or fundamental trading methods. So divergences are another tool that you could use in addition to the tools that you use usually in your technical and fundamental trading. They add rationale for any trading decision, and they often appear early so they can serve as prior warning indicators. Now, divergences are anomalies. Usually price and oscillator extremes should mirror each other. When divergences occur, there is an imbalance or a disagreement that is expected to be corrected by a price event. There are two categories of regular divergence that I'm going to talk about today. One is bearish and the other is bullish. So how do we measure divergences? Well, number one, we measure price. We have price on the top of our charts. Number two, we measure an oscillator, whether that's oscillator is a stochastics, an RSI, a CCI, MACD histogram, ROC, Williams %R, or really any other indicator that travels between horizontal bounds. Now, on both price and the oscillator, we use trendline drawing tool to compare heights of swing high to swing high, or the peaks, or swing low to swing low, or the troughs. Now, essentially, as I mentioned, there are two types of regular divergence, bearish and bullish. Here's what bearish regular divergence looks like. Over here, as we can see, we have price on the top up here, and then we have the RSI on the bottom down here. Now, for this chart, we could see that we reached a higher high in price, but the momentum oscillator in the RSI, as we can see here, is hitting a lower high in price, and this talks about a potential loss of upside momentum. Momentum is going to the downside. The higher high in price does not agree with the lower high in the oscillator, and therefore we're looking for some type of loss of momentum and a possible turn to the downside, and that's bearish regular divergence. Now, let's go to bullish regular divergence, as we can see here. For bullish regular divergence, it's just the opposite. We have a lower low in price. This follows this downtrend, as we can see here. Lower low in price disagrees with the higher low in the oscillator. In this case, this is the slow stochastics. So lower low in price, higher low in the oscillator. So we're looking at a loss of downside momentum, a loss of momentum to the downside, as we can see here, and therefore potential for a reversal or a turn to the upside. And that's bullish regular divergence. And that's essentially what divergences are. Please visit thetechnicals.com for more trading and technical analysis education. Thank you very much.